Hi, and welcome to this here framework, the third one here for financial accounting. In the previous ones, we talked a little bit about uh, how journal entries, journals get, the entries get posted into the general ledger accounts, and from the general ledger accounts, we create our financial statements. And then the last one, we talked a little bit about accounting periods. This one, we're going to talk a little bit more about the process, go a little bit deeper into this. But before I do, I just want to mention something here. As you can tell, that these are not professionally produced videos. I mean, I'm not taking the time to create all kinds of really neat PowerPoint slides and have, things scroll in and scroll out or whatever have you. I'm just presenting ideas as they present to me as if I was a teacher standing in a classroom writing on a blackboard, okay? So the advantage you have with these videos is that you can take notes. You can stop, you can pause, you can take notes. You go back and watch them again. So if you don't understand something, go back over them. Feel free to call an instructor if you don't understand something, but kind of like watch everything first before you do call, because a lot of the questions that you have will be answered in future videos or someplace along the line. If you're looking for the professionally produced PowerPoint slides and whatever have you, hey, it takes a lot of time to produce those, and you have all of that information in the textbook. So these are supplements to the textbooks. But you can watch these and get a good understanding, but don't just think, just watch the videos and you'll be okay. No, you really do need to read the textbook and study from the textbook. And these are just additional ramblings of a madman. Okay, so with that, I'm gonna continue on. All right, so a new slide here. Let me get to the new slide, and you know let me get my pen here. And it'll be in red. Okay, so we had talked about in the last video accounting periods, and in the previous one we had talked about, like I said, from journals to the general ledger accounts and create the balance sheet, the financial statements. But what I'm gonna talk about here is a little bit more of the process. So in the beginning, at the beginning of an accounting period, right? Uh, what you do is you start out with your general ledger and you create your beginning balances. Now remember, I'm only talking about framework here. I'm not going into specific examples. I'm not going to get into a lot of detail. I will probably do that a little bit more as we go forward, as I show you other things, and then you can piece that detail together. But to start with, what we want to do is we want to begin and we want to have balances in our general ledger accounts. Now, if you have a new set of books, your balances in all of your accounts are going to be zero. Okay. If you already have had previous accounting periods, well, at the end of an accounting period, which you'll see as part of the last step here, is that we create what's called a post-closing trial balance. All right. Now, a trial balance is nothing more than a listing of the general ledger accounts and the balances in those accounts. All right. It's sort of like a chart of accounts, which is just nothing more than a listing of accounts, but the trial balance has the balances in those accounts. So if you already had previous accounting periods, you are going to have balances in those accounts. To begin the new accounting period, you will make sure that that those ending balances become your beginning balances in your general ledger accounts. Okay. Then, as we move, and let's just take from an example, we'll talk about this in a monthly accounting period, all right? And I'm just going to pick any old month here, so I'm going to pick, say, March, all right? So on March 1st, you are going to make sure that you have your beginning balances, okay? Then what happens is, during the accounting period, which in this case would be 30 days, that's September, April, June, so there's 31 days in March, all right? Um, During that time, you're going to have transactions. Okay, transactions are you make sales, you purchase things, you have expenses that you pay for. All the things that happen during the course of the month that affect your business. And when you have these transactions, you'll generally have paperwork that goes with it, an invoice if you're billing somebody for a sale, a receipt if they bought something, if you buy something from another business, you're going to have a receipt. Well, all of those, that paperwork triggers the create, that's a transaction, and that paperwork triggers you're making a journal entry, all right? So you'll make the journal entry in a journal, and as you saw in the previous video, a journal entry is a journal entry. It really doesn't matter which journal it goes in as long as it gets posted to the general ledger accounts, but you would probably make the journal entry in the most appropriate journal that you had. I mean, if it's you're paying utilities, then you probably put it in like a cash disbursements journal, or you could put it in your general journal. You really wouldn't put it into cash receipts because you're not receiving cash, right? So you're going to make those journal entries, right? Then at the next part of the process is these journal entries have to get posted to your general ledger accounts, right? Now, it really all depends upon the business. Some businesses will post the journal entries every day, or when you're finished, like if you're doing accounts receivable, you might bill all of your customers, make those journal entries, and post all of those entries when you're done. So, depending upon the day of the week, you're going to do it on that day. Some businesses, would, you know, do their accounts receivable, say once a week. Well, then that means they would end up posting to the general ledger accounts once a week. The same with accounts payable. They might pay their bills one day a week, so they collect up all of their bills during the entire week, enter them into the computer system, and post them to the general ledger accounts, once a week. But the very minimum, okay, all of your journal entries have to be posted on the last day of the accounting period, which in this case here would be 3/31. So some businesses will, make journal entries all month and then just post it on the last day of the month, um, or at the last day of the accounting period. But the whole point being is that for the entire accounting period, on the very last day of the accounting period, all of those journal entries have to be posted into your general ledger accounts. Okay. Now, once they're posted into the general ledger accounts, um, what will happen is in that general ledger, you will calculate the balance in each and every general ledger account. Now, if you're doing this by hand, if you're doing your books by hand, you're going to end up, doing the math. Computer systems automatically have a tendency to keep a running balance of the account. So when you've got all of the balances in the accounts, you create yourself what is called an unadjusted trial balance. Okay, and again, the trial balance is nothing more than a listing of all of the general ledger accounts and the balances in those accounts. But notice I said unadjusted, okay? You know, trial balances, the name of the trial balance all depends upon when you're creating it. We're calling this an unadjusted trial balance because we had just posted all of our entries on the last day of the accounting period. They're not adjusted. We don't know that they're correct, okay? And we have entries, adjusting entries and correcting entries that we have to make in order to make sure that the balances in those accounts are correct. So once we have this here, unadjusted trial balance, we can go through and look at each one of those accounts and make adjusting entries. Sorry about that. Adjusting entries and correcting entries, right? Meaning if I think that, the balance of the account is wrong and I go back and I look and, let's say it's supposed to be, I don't know, I bought something for $100 and now all of a sudden in this account I see $1,000 that I owe. well, maybe I may posted that entry incorrectly and I would make a correcting entry. Adjusting entries are things like depreciation, where we have to adjust for the use of depreciation or our prepaids. And these are things that you're going to learn a little bit later on, obviously, and as you progress. But I'm just going through the process here. So once we have our adjusted trial balance, we're going to make adjusting and correcting journal entries. All right. And when we make those entries, then we're going to post them from the journal. We're going to enter them. Sorry. We're going to enter them into the journal. And then for step number 7, let me get a new slide here. For step number 7, we're actually going to go from the journal and post them to our general ledger accounts. Okay. So let me go back to 6 here. We figure out what our adjusting and correcting entries are, and then we're going to enter them into the journal, into our general journal, well, into one of our journals, mostly into our general journal. Once we have them in our journal, we have to post them to the general ledger accounts. And once we post them to the general ledger accounts, then we create an adjusted trial balance. All right. Now, the reason why it's called adjusted is because we just made adjustments. Oops. Let me erase that. Talking and not doing the right thing here. Adjusted trial balance. All right. So what we're kind of like saying is that when we have an adjusted trial balance, we're saying that the balances in those accounts are correct. All right. Those are the balances we're going to use to create our financial statements from. Now, if we look at the adjusted trial balance and we see that a balance in the account isn't correct, well, then we have to go back to make like step number 5 and make adjusting or correcting entries. We put them into the journal again, and then we post them again to the general ledger accounts, and we create a new adjusted trial balance. So that's like an iterative process, meaning it's a circular process that you're going to go through until you say, okay, my adjusted trial balance is correct. It's 100% correct. And those are the figures I'm going to use to create my financial statements. So once the adjusted trial balance is right, then number 9, the next step in the process. Now I'm just numbering these, so it's not like, I'm on step number 8 or I'm on step, no, it's just a process. I'm just using numbers. Because if we go through this iterative process here, if I made a mistake, well then number 9 would actually be number 5 again, and then number 10 would be number 6 again, and 11 would be number 7 again, and 12 would be number 8 again. And if I have a mistake, I'd have to, I'd be now looking at 13, 14, 15, 16. Okay, so don't pay attention too much to what step I'm on. It's just following in the process here. So once my adjusted trial balance is correct, the next thing I'm going to want to do is I'm going to create myself an income statement. Okay. Now I realize that you don't know what this stuff is if you're new to accounting, but you'll learn about it, going into the future. This is just an overview process, a framework, right? So I'll create an income statement, and the reason why I create an income statement because that's going to show me if I had a profit or loss for the period, right? And I need to use that profit or loss in order to be able to finish creating my balance sheet. Now, number 10, all right, theoretically, I would then create that balance sheet. Right? However, oops, how to GC balance sheet. However, there's 2 different ways that you can go about doing this, and I'll show you that as we go through, different processes a little bit more in detail. But right now, what you're kind of doing is saying, okay, I'm going to create my income statement, and then I'm going to create my balance sheet. And if I want to create any additional statements, like the statement of retained earnings, or let me get this down, earnings, or a statement of cash flows, or any of the other statements that I had alluded to in framework one, depending upon the business. You might have 5, 10, if you're a manufacturing company, you'd have 10 other statements that you would create, right? You're basically going to create all of those statements at this time, all right? Every business will create the income statement, and every business will create the balance sheet. And it'll be up to the business whether they'll create any additional financial statements. So once those financial statements are created, right, what we have to do is now we're going to close out the accounting period, right? And again, you'll see the detail of this, but the idea being here is that you have balances in your income statement, all right? And your income statement accounts, your revenues, your expenses, um, draw accounts depending upon the type of a business. And these accounts are called temporary accounts, right? Meaning that they have temporary balances in them. At the beginning of the accounting period, we want the balances in these accounts to all be zero, right? So that we can start afresh with the new accounting period. But at the end of the accounting period, there's going to be some amount in those accounts. Well, we have to get them out to return them back to zero. So what we do is we create closing entries, closing journal entries. Journal entries, all right? When we create the closing journal entries, we're putting them into a journal. We make the entry in the journal, and then we post them to the general ledger accounts, okay? And once we've posted them, get a new slide, yeah. And once we've posted them into the new accounts, into the general ledger accounts, then we create ourselves a post-closing trial balance, okay? Now, that post-closing trial balance, all right, is what has the ending balances in the accounts. Balances for that accounting period. Those ending balances, now remember, we were talking about like 331 here, okay? Well, those ending balances for the end of the accounting period, 331, now become the beginning balances for the next accounting period, which in that case would be 4-1. So now we're back to that spot. We're back here on, let me jump back to number 1 again. Now we're back to the beginning where we're taking the ending balances from the previous accounting period and we're making them the beginning balances for the next accounting period, right? When we make those we get those beginning balances. Now we go through the same process again, going through all of these various steps, okay, until we come back down here and we're starting anew, right? We have a new period, all right? New period, right? So it becomes just the same process over and over again for each accounting period. So if you have 12 accounting periods in the course of a year, you would go through this 12 times, okay? If you had your accounting periods were quarterly, well, that means every 3 months you'd start a new accounting period and you'd go through this process 3 times. If your accounting period was yearly, well, then you'd only do it once a year, all right? You go through this process, all right? So that's a little bit more detailed step process for what happens during an accounting period. I'm almost at 20 minutes right now, so I'm going to cut this off and I'll begin a new framework with something else. All right.